Hello, in this presentation we will record a sales receipt and the related deposit within QuickBooks Online. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to enter a sales receipt and then the deposit for the sales receipts. To do that, we're going to select the plus icon on the right side, so it looks like an X now, and we're going to go to the customers over here. Now note the difference between a sales receipt, which is what we will be entering now, and an invoice. Invoice meaning that we will be receiving payment at some point in the future, as opposed to the sales receipt. That means that we're going to get payment at this point in time and deliver the goods, in this case the inventory, at the same point in time. You can imagine the sales receipt as an item, as a receipt that would be generated within a store, as opposed to the invoice, which would be something that we would then generate and expect to mail out and receive at a later time in terms of a check at a later time. So we will be selecting the sales receipt. So we have the sales receipt item. We're going to select the customer up top that we are going, so we're imagining we are making a sale. At this point in time, we can imagine the customer being in the store, picking up a guitar within the store. It's going to be an ELP, an Epiphone Les Paul guitar that they're going to pick up. And we are going to sell it to them at this point in time and record the payment at the same point in time. So we could select the drop down to find the customer and or type in the customer, which is going to be Garcia Guitar. This is going to be a new customer. Therefore, we will add the customer. It will be a new customer type. And I'm not going to put the details in at this time. We're just going to say save and move to the next item. We don't have an inventory or an email. If we did, we could send it by email, but we're typically thinking that this is going to happen within the store. We're going to give the sales receipt at this time. We're then going to have the billing address. Now, the billing address could be important if we sell inventory, remember, because it will be needed to calculate sales tax in many cases. So to calculate sales tax, QuickBooks will do it automatically, but it needs to know the location that we're at. It needs to know the billing location that will be there, and we need to input the sales tax information in terms of the who we owe sales tax to, and set up those items. To see that, look at a prior presentation. Because this is a practice problem, we will be using a 5% sales tax, but in order to get that to calculate, what we're going to do is enter an address here. We're going to say that we have the address. This is just going to be an address that is in California, so it will then populate the sales tax. Then we're going to change the sales tax to 5%, just have a standard sales tax item. Remember that if you don't put this information in, the billing address, then it may not calculate the sales tax. It'll be something that you can't change. So for a problem like this, you have to basically set up sales tax, then enter something. You can't put the sales tax in the setup at this point because it does it automatically, but you can go back in and change it once it does the first primary calculation. So that's what we're going to do here, and we're going to tab through this. And we are going to say the date is on 02/12/21, February 12th, 2021. We are working in the future here. We're going to tab through this, and we're going to say the payment method. We're going to say we got a check. So here are the payment methods. We received a check at this point in time. Remember, we're making the sale at this point in time. The deposit is not going to go into the checking account right now. We instead are going to deposit it into an undeposited funds account, and then put it into the bank as we go to the bank at the end of the day, collecting all the checks we have, putting them into the bank in the same grouping so that it will match the grouping on the bank statement, and we can then tie out the bank reconciliations as needed. Then we're going to select the product, and it's going to be an ELP Epiphone Les Paul. So we could select the drop down to find that, and or type in ELP. We'll tab through this. We're imagining that they brought the guitar up here, up to the store, up to the front, and this of course would be what would be the guitar name on the guitar, and the sticker price then would be given, in this case $500. So we're going to say that they bought one. Here's the description populating for us automatically because we have already entered the item. We have quantity 1, the rate is 500. Sales tax will be calculated. It's not calculated yet because we're still on the same line. So hopefully when we click down to the next line, it will calculate the sales tax. But it is checked, so it should do something. We're going to click on that next line. and see that it should calculate something here. Now, it's calculating based on our location, the billing address, and what we have entered into the system in terms of who we owe sales tax to typically. And we're going to change that to flat 5%. So what we're going to do, just so it would be an example for any type of location, you can apply whatever rate is needed and or use QuickBooks to apply whatever rate is needed. So we're going to say 500 times 0.05, 5%, and we're going to say it's a $25 sales tax. So we're going to change this to 25 for our example problem purposes. It's going to say the system, QuickBooks says, hey, that's not what we came up with. Do you want us to, did we do something wrong? And we're going to say, no, keep the changes, you're okay. And I'll tell them that it's an example problem so that everything is okay there. So we're saying that we billed 500. We had to charge sales tax of 25, 5% on the 500. That gives us a total of 525. So if we recap what is happening from this sales receipt, it is a sales receipt. That means we got payment, in this case cash, but the check not going into the bank yet, going into undeposited funds, still an asset account increasing by the full amount, which would be the 525 we are receiving in the form of a check. The other side will be going up, which will be sales. It's only going up by 500. That's the sticker price of the guitar that we sold. And then the difference between those two is, of course, the $25 sales tax, which will be increasing a liability for the sales tax that we owe in the future. Also, what is going to be recorded, which we cannot see here, is the cost of goods sold for this guitar that we sold and the related decrease in the inventory. We don't have those amounts, but we know that the inventory is going down by the cost, which means what we bought it for. We could find that if we looked at the item list in order to see what we paid for the guitar. QuickBooks knows what that is and is using a perpetual system. As we make this sales receipt, it will then decrease the inventory and record the related cost of goods sold. So we're going to go ahead and save this. We'll check to see that it does what we expect it to do. So saving it, we're going to close this out and see our financial statements and go through those components to see if it's done what we said it would do. We're going to say reports on the left side. We're going to type in the report first, the balance sheet. And there is the balance sheet. The dates on the balance sheet are going to be the second month, 02/01/21 to 02/28/21. Then we're going to run that report. So within the balance sheet, we know we got cash, but we didn't put it into the checking account. We put it into undeposited funds. So it's an asset account. It's got $825 in it. Selecting that item, we see the 525 here. If we select that item, then we see our sales receipt. We're going to close this back out. Check out the other side of this. We're going to go back up top and go back to our report. The other side typically we think of as sales on the other side. So we're going to go to the reports and we're going to go to the profit and loss, which is where the sales will be at. Profit and loss report. And we're going to change the dates to the month of February, 02/01/21 to 02/28/21. February 1st to February 28th. We are working in the year of 2021. Run that report. We then see the sales side, the 500 here, selecting that item. We note that we only see the 500 rather than the 525. If we select that item that is on the bottom here, that's how much we got, but 25 of it is not going to be kept by us. We're going to have to pay it to the state for the sales tax collected on the sales price of 500, the amount actually earned, the amount then reported as sales or revenue. Closing this back out, we're going to go back to the balance sheet now. So we're going to go to the reports once again, look for that 25, which will be on the balance sheet. So we're going to type in balance sheet once again, selecting the balance sheet, changing the dates to the month of February, 02/01/21 to 02/28/21, running that report. Then we're going to scroll down to the liabilities section. We want to go down to the California State Board of Equalization. That's our location that we're going to have to owe this to. In a lot of places it would be called, if it wasn't a lot of other programs, it might just be called sales tax payable. or some type of payable, taxes payable account, if that's what it is. This, of course, is giving us more detail in terms of who we owe that to. And so if we select this item and scroll down, we see the amounts here for this sale. These are the three amounts that should add up to it, the 25. If we select either one of these, we will scroll down. That's being generated from this 25 sales tax. Closing this back out, we're going to go back to the report up top. The other side of this, remember, was that the inventory is going down, even though we didn't see that inventory amount on the sales receipt. So if we go to the inventory, we know we sold inventory, so this must be going down. And we select the item of the inventory that we sold. It's going to be the sales receipt is what we're looking for the 400. So if we select that 400, then we don't see 400 anywhere on the sales receipt. We see 500. That's because the 400 is what we sold it for. It will be there in the amount on the item list. To see that, we can close this back out. Let's see where that 400 get there from. We're going to go to the sales items here, and then we're going to go to products and services up top. So we're on sales on the left side, products and services. If we scroll down, we're looking for, I think it was the ELP that we sold, 500 sales price, 400 cost. So the system knows it's a 400 cost, although we're not going to put that on the sales receipt because our customer doesn't need to know that cost amount. Then we're going to look at the other side of that. We're going to go to the reports one more time. We're going to go to the profit and loss, and we will change the dates once again to the month of February, 02/01/21 to 02/28/21, and run that report. The other side is cost of goods sold. So here's the 500 we got in revenue. We got 525. 500 of it was revenue to us. It cost us 400, so the net increase then, of course, is 100. Selecting this 400, there's the cost of goods sold for that guitar. Selecting that item, we once again have our sales receipt here. Closing this back out, we're going to now record the deposit. So we're going to scroll back up top. We're going to select this little plus icon. And you can think of the deposit usually as part of the customer section, although it is over here in the others section. Meaning what typically happens is we're going to invoice the customer and get a bank deposit in the mail, or we're going to create, as we did here, a sales receipt, get a bank deposit in the mail. The reason the deposit's not in the customer section is that there's a significant amount of times that we may not have that as the way we got the deposit, meaning we could have got a loan, or possibly we put money into the system. So there's other types of transactions that can have a deposit, but hopefully the deposit most of the time is really part of the customer cycle, meaning we're billing the client, we're getting money, and we're depositing that money into the bank. So we're going to go ahead and record that deposit, and that's going to be the concept that we have here. We just got a sales receipt, and we recorded that into undeposited funds. We're going to group those sales receipts together with any other deposits we have not yet gone to the bank with yet, and then record those deposits at this time. So here are the deposits. Checking account. We're going to make the deposits dated at 02/12. We're going to say 02/12/21. 02/12/21. So February 12th, the year we are working in, 2021. Here's the sales receipt we have. We're going to check that off. We're going to deposit that. We also have these other two that we had received these for, and we're going to deposit these as well. And two other sales receipts that had happened that we have not yet gone to the bank with. We're going to deposit them at the same time. So we're going to have a deposit then of 825. Not just the 525, and therefore when we look at our bank statement, it's going to show a deposit of 825 that we can then match out to our books, which should be grouped in the same way at 825. So we're going to go ahead and save this. Once we do, however, let's make sure we know what's going on. It's going to go out of our checking account. So of course, it's going to go into our checking account because we are depositing into the checking account. And the other side will be the undeposited funds. These are all items that we got money from, typically a check or cash, and haven't gone to the bank with. So we put those into an account called undeposited funds so that we can record the other parts of the transaction not yet putting it into the bank because we want to do that at one time, grouping them together as they will be grouped in the bank. So let's save this and see if it does what we expect it to do. We're going to close this back out. We're going to go back to the reports. I'm going to go to reports on the left side. We're going to type in the balance sheet. So balance sheet this time. We're going to change the dates from 02/01/21 to 02/28/21 and run that report. We will then check the checking account. That's where we deposited it this time. Finally, put it in the checking account. If we select that item, here's the $825 deposit that we have. Selecting that item will give us our deposit. Here's the $825 here. We will close this back out. We're going to close this back out. We're going to go back to the balance sheet, so back to the report, which is the balance sheet, and see the other side of it, which is the undeposited funds. Note that QuickBooks is nice here in that there was activity in this account, so they didn't just make it zero. They didn't just take it away. They did make it zero and left it on the report so that we can see the detail. We can use this auto zoom function and say, yeah, I know it's zero, but what just happened to it? If we select that item, then we can see that we have the breakout. And notice that they broke it out here. They didn't just put the one deposit of the 800. They're saying here it was consisting of these items here. We deposited the 525, the 100, and the 200, which would give us, if we select any of those, the 100, the 200, the 525, or the 825 that was made as a deposit on the date February 12th.